Welcome to this lesson on private equity. Private equity represents a fascinating area of investment that operates completely differently from the stock market most people are familiar with. In this video, you'll learn what private equity is, how it differs from public stock markets, and why typical retail investors don't have access to these investment opportunities. Let's dive in. Private equity refers to investment capital that is deployed into companies that are not publicly traded on stock exchanges. Unlike stocks you can buy through a brokerage account, private equity investments involve companies whose shares are not available to the general public. These are privately held businesses, meaning their ownership is restricted to a limited group of investors. The key distinguishing feature is that these shares cannot be bought or sold by retail investors on public markets like the New York Stock Exchange or NASDAQ. To understand private equity, it's essential to grasp the fundamental differences between private and public markets. Public stocks are traded on exchanges, which means anyone with a brokerage account can buy shares of companies like Apple or Microsoft. These markets offer high liquidity, allowing investors to buy or sell shares almost instantly. In contrast, private equity deals with companies that are not publicly traded. Access to these investments is highly restricted to specific types of investors. Additionally, private equity investments have limited liquidity, meaning you cannot easily sell your stake whenever you want. These differences create entirely different investment dynamics. Private equity firms follow a systematic approach to investing. First, they raise capital from institutional investors and wealthy individuals who meet specific financial criteria. Second, they use this capital to acquire full or partial ownership stakes in private companies. Third, they don't just passively hold these investments. Private equity firms actively work to improve operations, streamline processes, and grow the business over several years. Finally, after typically 3 to 7 years, they exit the investment by selling the company to another buyer or taking it public through an initial public offering. This entire cycle is designed to generate substantial returns for their investors. Private equity encompasses several distinct investment strategies. Venture capital focuses on early-stage startups with high growth potential, providing funding to help innovative companies get off the ground. Growth equity targets established companies that are already profitable but need expansion capital to scale their operations. Buyouts involve acquiring controlling stakes in mature businesses, often taking them private if they were previously publicly traded. Finally, distressed investing focuses on struggling companies that need financial restructuring and operational turnarounds. Each type carries different risk and return profiles, but all share the characteristic of investing in non-public companies. Access to private equity is strictly limited to accredited and institutional investors. This isn't a restriction imposed by private equity firms themselves, but rather by securities regulations designed to protect less sophisticated investors. Typical private equity investors include pension funds and university endowments that manage billions of dollars in assets. Insurance companies and family offices that manage wealth for ultra-high net worth families are also major participants. Individual investors can only access private equity if they meet high net worth requirements, typically having income exceeding $200,000 annually or net worth above $1 million, excluding their primary residence. These restrictions exist because private equity carries significant risks and requires long-term capital commitment. Private equity investments have several defining characteristics. First, they are long-term commitments, with investment horizons typically ranging from 5 to 10 years and very limited liquidity during that period. Second, private equity involves active management, where firms take a hands-on role in company operations and strategic decisions, unlike passive stock market investing. Third, private equity requires high minimum investments, often starting at $250,000 and sometimes reaching several $1,000,000. Fourth, while private equity offers the potential for higher returns compared to public markets, it comes with significantly higher risk, including the possibility of total loss. These characteristics make private equity suitable only for sophisticated investors with substantial capital and risk tolerance. Let's summarize what you've learned. Private equity invests in companies that are not traded on public exchanges, creating an entirely separate investment universe from the stock market. Access to these investments is restricted to institutional and accredited investors who meet specific financial thresholds. Private equity offers potentially higher returns, but comes with longer time horizons, less liquidity, and higher risk compared to public stock investing. Most importantly, private equity is fundamentally different from buying stocks on public markets in terms of access, structure, involvement, and exit strategies. Understanding these differences is crucial for anyone studying advanced investment concepts.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.